Hi guys, this is one of our back to basic videos for those that are just starting their journey running their own business. So this might be you're starting your own journey trading on your own, which is what we call a sole trader, or this could be potentially where you are running in business with someone else, maybe one person or two or three, and that would be classed as a partnership. This video isn't for those that are running a limited company. But it also might be where you are employed and you've got a side hustle and you need to declare the income on that to make sure you pay the correct amount of tax in the UK. So we'll walk you through how the system works in the UK, when you need to pay your taxes by, what you need to declare, and that should give you a good start for 10. So if you say start running your business in January 2023, that falls in the UK tax year from the 6th of April 2022 and that ends on the 5th of April 2023. So you start your business in January 2023, you're going to need to declare the income that you've received from the period the 6th of April 2022 through to the 5th of April 2023. And that sits on your tax return, a self-assessment tax return that you can either submit and prepare yourself or you can get an advisor to do on your behalf. So how do you start that process? The first thing you need to do is inform HMRC that you're in business, and you need to inform them by the 5th of October following the end of the tax year. So going back to the example that you've started business in January 2023, you'll therefore inform HMRC by the 5th of October 2023 that you're in business. You can complete an online form that's quite simple. You need to set up what's called a government gateway on HMRC's website. We'll pop the links in the comments below, so you can click on that. And at the moment, it's a short form, which you're informing them that you're running your own business. And then what you need to do is once you get past the end of the 5th of April 2023, you will then be in a position to pull together all your information and data and submit that to HMRC. So firstly, what do you submit to HMRC? So you need to declare when you're a trading business your profits and or your losses, and we'll touch upon losses a little bit later on in this video. And so this basically is your sales, so your turnover, your income in your trading business, less running expenses and costs, and that gives you your net profit, which is what you'll declare on your tax return. So you'll see this example here where you can see this business in sales, they have a turnover, and what we've done there is we've deducted from that the cost of sales. Now your cost of sales are generally items that if you weren't trading you wouldn't incur. So in this one, there's lots of raw materials that have been converted and used, and then there's other general materials. If this business decided to cease trading for 3 or 4 months, none of these costs would be incurred during that period because they wouldn't have those sales. And that then gives you your gross profit. And from your gross profit, you deduct your expenses, and these are basically admin and operating costs. So for a lot of businesses, that could be premises rent, that could be storage costs, light and heat costs, business rates. Now, a lot of smaller businesses can get business rates exemptions, so it's not every small business has those costs. IT costs, I think generally, if you were running your business from home or from an office or a warehouse, you're going to have IT costs. So these will be your broadband costs, but it'll be also things like your software costs. So you might use software to do your accounts production and your invoices. So that could be something like Xero or QuickBooks. So for those costs are tax deductible. Your mobile phone running costs, call costs, printing and stationery, notepads, pens. Insurance costs would generally, most business will have insurance of some form. And after you've deducted those costs that you've incurred, that will give you your net profit or loss. And this is what you include on your tax return. And generally, this is what you're going to pay your profits on. So how and when do we need to submit your personal tax return, your self-assessment tax returns? Okay, so if you're going to submit these on paper, which to be honest now, not many people do at all, I would say you need to have this submitted by the 31st of October following the end of the tax year. So your business started trading on the January 2023, where you submitted a tax return for the year ended the 5th of April 2023. So you would need to submit that tax return on paper by the 31st of October 2023. Now, we certainly at the moment, there is real postal strikes and things like that, so I wouldn't rely on submitting a paper tax return and getting it there on time. So most people submit them online. I would say that 100% of our clients submit online self-assessment tax returns to HMRC, and these need submitting by the 31st of January following the end of the tax year. So again, we're submitting a tax return for the year ended 5th of April 2023, and therefore this needs to be prepared and submitted with HMRC by the 31st of January 2024, which does seem like a long time away. However, we recommend to our clients to get it prepared as soon as you possibly can, generally summer, and then you're aware of what your tax liability is well in advance. If you don't prepare your tax return on time, you will incur penalties from HMRC. So if you've declared that you're going to submit a paper tax return and you don't submit it on time, which is the 31st of October following the end of the tax year, you'll incur penalties. And if you are submitting online, which most people do, you again will incur penalties if you do not submit this on time. So if you miss the 31st of January filing deadline, then you will receive an initial penalty of £100, and that's standard across the board. So if you submit it on the 1st of February, you're going to receive that penalty. And then if it's up to 3 months late, you're going to incur a daily penalty of £10 a day for the next 3 months. And then if it's up to 6 months late, you will also incur a 5% tax surcharge. So whatever your tax liability is, you're going to incur a charge of 5% on top, or £300 if it's not a lot of money, is the surcharge. So it's basically 5% of your tax liability or £300, whichever's the higher. If you've still not submitted it by the end of the year, so if it's up to 12 months late, you'll get an additional 5% tax liability surcharge. So that could end up being quite hefty by the end of the year. If it's over 12 months late, HMRC have the discretion to charge additional penalties on top. In particular, they can charge even more penalties for things and saying it's deliberate or you're concealing paying tax. So we don't recommend absolutely and utterly getting your tax paid getting your tax return submitted as soon as possible. So we've covered what you declare. Now, if you are potentially running your business and you start in, say, in January 2023, you're starting your business mid-year. And it might be you've been employed up to, say, December 2022. So on your tax return, you also need to include your employment income as well. So you need to include all sources of taxable income. So if you were employed for the previous tax year, you don't need to do anything. But once you're trading, you need to include all sources of income, and you basically include the information that's either on a P60 or a P45 that you'll have received when you finished your job. So if you finished your work in, say, I don't know, the 10th of December 2022, knowing that you're going to start your business from January 2023, you would need to make sure you've got your P45 that your employer should have sent to you from finishing your job. And you also need to include that information on your tax return because you've already paid tax on that at source, which is what you do when you're employed. You pay tax by a PAYE through your employer. So now we know when we need to submit our tax returns by, we have a good idea what we need to include in our tax returns. And if we've been employed partway through the year, or you still continue to be employed, you need to include that information. One of the, I think a couple of catch-outs, when you're preparing your income and expenses to include on your tax return, not all expenses are allowable. So you need to have the mindset that basically anything that was incurred 100% for your business, that was wholly and exclusively incurred part of running that business, you can include. You might be able to include a percentage of some costs. For example, if you are working at home and you don't have rent and external premises, a percentage of those costs could be included. Certain things are absolutely not allowable for tax deduction. Client or customer entertaining. So this might be where you decide to take a key customer out for lunch one day. You can't have the tax deduction for that. You might decide to give them some gifts, and there's some rules around what those gifts look like. So for example, you couldn't decide to splash out and take 2 of your best customers to say to the Grand Prix in the UK. Well, you could, but you won't get a tax deduction for that, because that's customer or client entertaining, and you just can't have the tax relief for that. So you can spend that, you can choose to spend that if you want, but you can't have the tax deduction for that. You can get tax deduction for small incidental gifts. So for example, if your gift to your customer is under £50, and it has your business name or logo on, so it's essentially advertising, and it's not food or drink, unless of course your business is food and drink, then you can have those. So it's really incidental small things. But generally, when you're thinking about your costs that you've incurred, you've just got to take a step back and think, would you have incurred that cost if you'd not been running that business? Now, things that you don't get tax deduction for off your profit and loss, which is the document that we shared with you earlier, things like your capital expenditure. So this is machinery and big costs. So I would say 99% of us have the cost of a computer equipment. So that could be a Mac, it could be a laptop, the ancillary things that go with that, printer, storage costs. They're what we call capital expenditure, and you get tax relief through those, through what's called capital allowances. And depending what that capital expenditure is, are different rates of capital allowances. But most common ones, that most generic ones for businesses are computer equipment. It could be furniture for maybe for your office or for your warehouse. It's generally things that last more than a year, that you're not going to have for 1 year, and then you're going to keep for 2 or 3 years. So for example, in our office, we've got desks that I think we purchased about two years ago. They're probably going to last for another 5 or 6 years. They sit on our balance sheets, capital expenditure. So you need to bear that in mind. So it's not quite as simple as it looks, and we're trying to make this as simple as possible. Personally, we recommend you instruct an accountant or a tax advisor to help you. The costs don't have to be humongous, and the costs are tax deductible from your business. So now I want to touch on paying your tax and how you go about doing that. So your tax liability needs to be paid by the 31st of January after the year end. So if you remember, we are preparing our tax to the 5th of April 2023, and therefore you need to pay your tax by the 31st of January 2024. So that's the same day as the last day of your submission deadline. Now, this is why we suggest to most of our clients, we suggest to all our clients, get your tax returns done over summer. We say by September, October, you know what your tax liability is going to be. You've got time to make sure you've got the money available. You can pay it earlier, but you just need to make sure you've got it paid by the 31st of January. If you don't make payment on time, you will incur penalties and interest. The interest used to be quite low, but obviously interest rates are a lot higher now. So this can be significant and rack up quite quickly. If you can't afford to pay your tax liability for whatever reason, you can contact HMRC to arrange a payment plan, and they'll put that in place. And I think you have to agree. I think it's something along the lines of a certain amount each month. And that you can pay that. So again, it's one of those things where I think being organised and getting yourself sorted in advance is worthwhile to make sure that you don't incur too many costs. If your tax liability is over £1,000, then what will happen is you'll have to pay a payment on account to HMRC. And a lot of people get caught out on this on the first year that they're running their business. They think, the tax is £1,500, it's £3,000, that's fine, I've got that put aside. But what happens is you have to pay a payment on account if your tax liability is over £1,000. So, for example, your tax liability is £5,000 for your first year's trading business. And because of that, you need to then pay 2 payments on account. Your first one being on the 31st of January when your tax liability is due. And that payment on account is 50% of the tax liability for the year. So we're demonstrating this in an example. It's a lot easier to get your head around. So your tax liability is £5,000 and you need to pay that on the 31st of January after the end of the tax year. But also, because it's over £1,000, you've got to pay an additional 50%. So that means you've got a tax liability of £5,000 plus an extra £2,500 for the payment on account for your next year's tax liability. That needs to be paid on the 31st of January 2024 in this example. And then on the 31st of July 2024, you've got to pay another 50% up, so another £2,500 then for the tax liability in advance. Essentially, what this is you're paying your tax, your self-assessment tax, 1 year in advance. So then when we come to submit the following year's tax return, the same cycle happens again. Where there are some caveats and some differences with this payment on account are when it might be you cease trading in a few years' time, you decide running your own business isn't for you, and you either have made lots of money in that period and you don't need to work anymore, or most likely is you decide it's not for you and you go back into being employed. In that case, you can apply to reduce your payments on account because you know your tax liability is not going to be as high. And if you've had a big year for 2 or 3 years where you've paid higher tax, and then you might have a poor year where your profits are not as high, you can apply then to reduce that payment on account. So that there is options with that. So I think that's a big watch out that a lot of people don't realise is there and can happen. Payment accounts will go eventually with making tax digital, but that's just been put back from 2024 going live to 2026. So this is something that's going to change, but at the moment you need to know about it and need to be aware of it from a cash flow point of view. What I want to touch upon now is record keeping. Record keeping, you need to basically keep records. These can be digital records or paper records. We don't keep paper records in our company because we're keen to make sure we're paperless. We've always been paperless. We have a few bits of bobs of paper knocking around, but not much at all. So we scan everything in. So for running our company, we use Xero for our software. We raise our invoices through that and everything goes through that. And so when we make purchases, say we purchase some stationery from Amazon, so when I go into my Amazon account, I click on there, download the invoice from the purchase, move that over onto my Xero expense, and when I reconcile my bank, I attach that to that. That's how we deal with it. And we also have an invoices file where all invoices get dropped as well. You've got to keep records. You need to move to keeping digital records anyway. And your records, you need to keep records for 5 years from the 31st of January after the end of the tax year. So, for example, we're submitting the tax return for the 5th of April 2023. So you need to keep your records for 5 years from the 31st of January 2024. So basically we say to clients, just keep everything for 6 years. Absolutely keep everything for 6 years, and then you can archive or destroy it from that point. You need to keep it because you can have a tax investigation or inquiry for any point up to 6 years' time. And if you've not got records or good records, you can receive a penalty of up to £3,000. Yeah, it's £3,000 in every instance. So, for example, you destroy all your records, or you don't keep any records, and you get an investigation in year 2. and you've not kept records for the first 2 years, you could receive penalties of up to £3,000 for both of those tax years. And so that could be £6,000. So these, this can really rack up quite quickly. So you need to be aware of that. And it's just good, you could store it on a hard drive, you could just store it on your Mac or your computer, or, in Google Docs. A lot of our clients seem to use Google Docs. A lot use upload onto Xero, which is great because then we can access it and can check things if we've got any queries. Basically, you just need to bear in mind that you need to be able to extract that data and be able to send that to HMRC as proof that you've kept records. Now, just coming to the end of this, the only area that I think we've not covered is losses. If you start running your business in the first year, it can generate losses. Now, a lot of people might think, I'm not going to tell HMRC because I know I've made a loss because I've incurred lots of costs, and I'm doing this, for a long-term gain. The losses that you incur in your first year there's two things that you can do with them potentially. If you create losses, so say you've generated £5,000 worth of losses of your business in the first year of trading, and that's not uncommon, and certainly depending on the type of business that might be expected when you set up. What you can do is you can roll forward those losses to the next year or the year after that. So if you make a profit of, say, £20,000 in year 2, and you've got £5,000 worth of losses in year 1, you can roll those forward and offset those against. So therefore, you'll have less tax to pay. Additionally, to realise those losses as soon as possible, because realistically we want to do that because it helps cash flow, and at the end of the day, the saying is really corny, but cash is king. Without cash, you can't run a business. So in this instance, what you can do is, if you've been employed partway through the year or have employment income as well as running your trading business, so say you were employed and you left your business in mid-December, like we've said earlier, and you've had employment income and you've paid tax on that employment, and then we've got a loss for your trading business, and it does have to be a trading business, of say that £5,000. What you can do is offset that against your employment income that you incurred during the year, and that will then mean that you reduce the amount of tax you paid through your employment, and you'll get a tax refund. So it's worthwhile looking at the options in your first year. And again, this goes down to getting tax advice, and a lot of people know, well, I can do it from other sources and I can guess myself. You can, but you could end up potentially missing out on cash. We recommend getting advice, but that's us. That's what we do for a living, and we can see where people miss reducing their tax liability or getting cash back into the business. So I think we've covered most of the things we want to do in that. I think there's a couple of caveats on the end of this. If you're running as a partnership, and we will do a separate short video on partnerships, what happens is the partnership never pays tax. The partnership is registered at HMRC as a partnership, and you need one of the people that are in business with. So say there's 4 of you in business, you've got partnership. You need to notify HMRC the name of the partnership when the partnership traded business, and you need to nominate one of the 4 of you that are partners in the business as a nominated partner. The partnership gets a UTR number, a unique tax reference number, from HMRC, like you do as an individual. You need that UTR number to be able to submit your tax returns. But if you also, the partnership doesn't pay tax. The partnership, you work out how your partnership will pay, the profits of the partnership, and that's divided between the 4 partners, depending what your profit share is, and then those partners declare that income on their personal tax returns. So if you're setting up a business, all 4 of you have never ran your own business before, but you're all going into it and you all have a 25% share each, the things you need to do is register the partnership as a partnership with HMRC, slightly different form, we've included it in the link. One of the partners needs to be nominated on there as a nominated partner, so they get all the information from HMRC. And then all 4 partners also need to register for self-assessment, informing them that they're part of a partnership, and you would go about it the same way. The only difference is the partnership works out the profits, and then those are divided up per the profit share. I hope that helps. And it should give you a good idea as to what you need to look for and go into. My top tip would be, and this is just purely and utterly from having clients coming to us in a panic at the end of the tax year, when the filing deadlines are and not knowing how much tax to pay, is just try and do this as you're going along. Get your tax returns prepared as early as possible in the tax year. Like I say, summer's a good time. Then you know what your tax liability is, if you've got payment on account or your losses, and you're not doing everything last minute, and you're a bit more prepared. I hope that helps. We would welcome comments. If you've got questions and queries, we can answer as much as we can, but we don't give full tax advice and go in depth on these, because we do that for our clients. But what we're trying to do is point you in the right direction so that you start off on the right footing. And without a doubt, I think it's worthwhile investing in some of the software that's out there. Some is better than others. We have our views as to what works better, but I think it's down for you to trial and error. Personally, we deal with clients that are on Xero and QuickBooks. We have a few on Free Agent. We're not huge fans of it, but QuickBooks and Xero for us seem to be the better offerings on the market that seem to be a little bit more advanced. But there is a whole host of others, so it's what works for you. Thanks for listening. I hope you've found this informative, and I hope it helps you on your business journey, whatever that is. And thanks for watching. Bye.